The recorder is started. Welcome everybody to September 29th members meetup. And as we always do to start out, we go over our entry and exit walkthrough. Very important that this becomes solidified in your mind and it becomes second nature to you. I also see a couple new people in the audience, so welcome to you. What I'm going to do is I go over this, and then I'm going to have a couple of words to say about some of the corrections we always have in September and October. I'm going to go over a little exercise that I went through with Dr. Van Tharp. And then, of course, we always review our current trades and the market. At any time, there's plenty of time for questions. A couple ways you can either unmute yourself by clicking on the hand, and when you click on the hand, I'll unmute you, and then we can maybe chat together. The other way is to go ahead and type it in the question box. And it appears like most people like to do it that way, so that's the other option. Okay, so our entry and exit, the tools we use, of course, are the standard deviation on the regression channel. And when the price moves out of bounds, if you will, either plus or minus 1 or plus or minus 2, that piques our interest, because the price is contained within the regression channel. And we're looking for the price then to revert back to the mean. And we're looking for a confirmation of that, either with a measured move or the 5 cross the 5-day exponential moving average line crossing the 8. For a bullish move, we're looking for it to cross above. And for a bearish move, we're looking for it to cross below. Secondary entries are the ones we usually have, and that's when we're in a trend and we have a pullback of the price, and this is then followed by a measured move or the 5 crossing the 8. That's a secondary entry. So these are the two entries we're looking for. Now, as soon as we get into a trade, we know how we're going to get out of it, and that's the beauty of this strategy. A lot of people just teach entry. They don't worry about the exit, and the exit is probably more important than the entry. I've run tests. I've had other professionals run tests where they are given a trade at random and can make money if they follow exit rules. So the exit is very, very important. Now, if we get a measured move opposite the trade, or the 5 crosses the 8, that is going to be an exit the trade with a loss. Yes, indeed, we do have losses. We have losses, we'll have a string of losses. One of the important things, and you'll see that in the exercise I'm going to talk about today, is if you've got a positive expectation trading strategy, and this what I teach you guys is a positive expectation trading strategy. Your job then is to learn it and execute it and not second guess it. If we have a 75% win rate, that means we've got a 25% loser rate, okay? So if you have, let's say if we have 1, 2, 3, 4, 5 losers, okay? What's the probability that the 5th one will be a losing trade? You know, a lot of people put more money on that, saying, hey, we've had a losing string, it's gonna turn around. No, the probability is exactly the same as it was on the first trade, and that is 75% win, 25% loss. Okay, so you always want to keep that in mind. And that's why when it goes against us, we have to suck up our ego and get out. Now, if it's running, if it's profitable, we just let it run till we get around the Fibonacci's of 127, 161. We can preset them. I wouldn't want to put in a limit order or a good till canceled on that, because even a limit order, when it gets executed, when it hits that point, it then becomes a market order. So you can lose some of the slippage between the bid and the ask. So we don't want to target that, but you can preset this on your Thinkorswim to create an alert that when it gets to that point, you just are alerted, hey, it's to that point, and you can go on your computer and you can take a look at it and you can say, yeah, okay, I want to get out right here. I want to get out right here. Okay. This is, you see that the market is down 20 today right now. The 5 is very close to the 8, crossing back over. We've had, let's see, there was 1, 2, 3 positive days, and a lot of people saw yesterday it was up 52 points, and they're saying to themselves, boy, I'm losing money if I'm either out or hedging. No, you're not. No, you're not, because your portfolio is making money. Your portfolio is making money. The hedge is losing money, but the net is going to be positive for you. Now, let's just take a look at this. Let's say you can't get in right when it crosses over. So let's say right down here you go ahead and buy a protected put. Let's say it's at 34. I don't know. Let's call it 34.60. Okay. And the low rate here was down around 32.80. Okay, that is a big drop on the SPX. That's a 180-point drop. All right. So by having protection or being out, you've saved this money, and you don't have to worry about timing this just right. You wait for the 5 to cross over the 8, and it hasn't done that yet. It's very close to doing that, but it hasn't done that yet. So we just wait on the sidelines until that happens. When that does happen, and it might happen tomorrow, it might happen the next day, it might happen next week. We don't know. But we do know that when the 5 crosses over the 8, it's time to get back in, or get rid of your hedge and let your portfolio run. Okay, so this was a pretty good size correction. All right, so let's go up here for a second and just take a look at the SPY. And I'm going to go back on the SPY. I'm going to go back. Well, let's see how far back I can go. Let's go back 15 years. Okay, and I'll blow that up a little bit, and we'll go all the way back here. And what I want to do is I want to show you guys what happens in the month of September and October. Okay, going all the way back to 2005. During the month of, usually between mid-September and mid-October, there is usually, not always, nothing is 100% in the market, but usually there is a correction. In 2005, there was almost a 5-point correction. 2006, nothing. 2007, 10.8. 2008, 30.7. 2009, 7.4. Nothing in 10. Then 18.7, 8.8. I mean, these are pretty decent sized corrections. You want to stay out during corrections, or you want to be hedging your portfolio during corrections. Now, I'm not going to look at compounding and everything like that. I'm just going to look at normalizing. If we look at the SPY back in 2005, it was at 122. Currently, it's at 322. That's 164%, or about 8.2% per year. And that's the kind of returns you could have gotten if you would have just stayed in the market. But holy smokes, you got to have a lot of courage to stay in the market when you're dropping 30.7%. Okay, what I did is I totaled up all these and said, okay, over the last 15 years, if you would have stayed out of the market during mid-September to mid-October, just stay out between mid-September and mid-October, you could have saved yourself 144 points on the SPY. Add that to the 322, now all of a sudden you're looking at 17.2% per year. Now this is normalized, this isn't compounded. Compounding would be even higher. And basically what this study shows you is that historically September and October can be correction months. Why? I have no idea. I have no idea. A lot of times the market and the market makers and the institutions and everything, they just remember. They just remember, hey, this is the time of the year it's weak, okay? And you probably all heard of the Santa Claus rally towards the end of the year. Now, whether we're gonna have that this year or not, who knows? It's all gonna depend on the election on November 7th. It's all gonna depend on that. That's gonna be an interesting time, and guaranteed I'm gonna be out of the market. Because I don't know. I don't know what's going to happen depending on the election. Okay, I just thought you'd find this interesting. It's just a market fact. Does it happen all the time? This was 15 years, and 1, 2, 3, 4 years it didn't happen. Okay, so we're probably looking at about 70, about 80% of the time it does happen. Is that 100% of the time it happens? Nope. You know, but most of the time it does happen. It's just something to keep in the back of your mind. Okay? Something to keep in the back of your mind. If you'll notice, if you go back and take a look at my trades, you'll notice most of my trades during September, October are bear calls. Bear calls. What have we been in? What have we just recently got out of? 4 bear calls, all profitable. What are we in now? Well, we're in 2 bear calls. One of them's profitable, the other one isn't. We'll take a look at those today. Okay. Okay, thought you would find that interesting. So let me get rid of that. And so let me just show you. You know, here's the September October period. Okay, nothing happened during this period. Let's just take a quick look at this as we go through. September October period. Okay, that was 2000. That was 06. September, October, Holy smokes. Okay, that was 08. September, October, just a little tiny one. Okay, pretty flat, pretty flat. Let's go up here, September, October, down. September, October, down. September, October, down. September, October, down. A little bit of a rally and back down. September, October, down. Okay. September, October, down. September, October, down a little bit, down a little bit. Surely wasn't up. Surely wasn't up. Little bit of a pullback there in 2017. September, October, yeah, down. And September, October, down with a little bit of a rally and back down again. And of course, then we were looking at this year right now, and we are down September, October. So it's just something to keep in the back of your mind. Like I said, about 75, 80% of the years this occurs. Be cautious during the September, October time period. Now, the last couple of days have been very strong, okay? But the 5 hasn't crossed over the 8. And a lot of times the market will come back down and kind of test this. And that's what I'm looking at now. We're not through the, we're not even into October yet. So, I'm thinking of maybe a little bit more weakness and then maybe a little bit of a rally into the elections, and then who knows what's going to happen. So we'll be cautious. We'll be cautious. Okay. Any questions on that? All right. About 15 years ago, I took a seminar through Dr. Van Tharp. Dr. Van Tharp is a psychologist that works with traders. And he started out the week-long seminar with an exercise that he does with all his classes. And this was a very eye-opening exercise for me at the time. And he basically said, okay, let's say I've got 2 containers, and one container has 40 white balls in it, and the other container has 60 black balls in it. And what I'm going to do is I'm going to take those 2 containers and I'm going to put them together and I'm going to shake them up really good, really good. Okay. So basically, you're going to have a container that has 60 black balls in it and 40 white balls in it. All right. Okay. Now, the thing is, if a black ball is drawn out, you win whatever you risked. If a white ball is drawn out, you lose whatever you risked. Okay. This game has a positive expectation of 20 cents for every dollar you risk. Okay. Because there's 60 black balls and 40 white balls. So if you risk $1 every time you pick out a ball, you're going to have a positive expectation of 20 cents every time you pick a ball or make a trade, okay? Okay, so here is the interesting part. And he didn't tell us any of this before we picked balls. And yes, indeed, I lost money because it went through. I think I had like a string of 4, and then I think I put on like 20 times what I normally did, and of course I lost. So my ears were piqued as to this, but then I felt better because he said, "What percent of people who play this make money?" So what do you think? How many people that play this game over the years have made money? Anybody want to guess? You just type it in the question box. Take a guess. How many people that played this game, which is a positive expectation game, 100% of people should have made money. How many people made money? 3% is a pretty low number, not quite that low, but it's on the way. 20%, yeah, you're getting closer. You're getting closer. 50%, okay. 60, okay, okay. Now remember, 100%, here's a 5%, 5%. Okay, so you probably are not going to be surprised then. I mean, this is a positive expectation game. Everybody understand this? There's 60 black balls, 40 white balls. If you just say, put on the same amount every time, I'm going to bet $1, I'm going to bet $1, I'm going to bet $1, I'm going to wager what I should as far as my trade size is concerned, okay? I should be a winner. All right. Typically, 1/3 of the audience ends up broke. Another third loses money. And only 1/3 of the audience makes money. And these results are not unique. He's been doing this, he's been teaching this for many, many years. He even went so far as to get 100 PhDs from the local college and ran it with them, and they had the same results. And that's the problem. That's the key problem in trading. Okay. You can have a positive expectation trading strategy and lose money. What I'm here to do is to teach you guys how to avoid that and how to make money. Because it's more than just getting into the trade. It's getting out of the trade. It's having rules. It's following rules. Know when to get into a trade. Know when the setup is correct. Know when to exit. Okay. If people have trouble making money with a 60% probability gain, 75% for us, what are the chances of making money in the market? Very slim. Okay. So how do we get around that? Okay. There are 3 critical factors to winning. First of all, you need a positive expectations system, and we have that. The second thing is we need proper position sizing. And what do I mean by that? What I mean by that is based on your portfolio size, you can determine what your trade size should be. Never go over that trade size. Most professionals will not invest more than 1% of their portfolio on any given trade. Now, remember that's risk. That's how much you're going to risk. If you've got a system that makes more money when you win versus when you lose, you can base it on what the percentage is that you lose, and that's how much you're going to risk. Okay, and I've got a whole thing on trade size on that. It's on YouTube. It's on the website. trade size, the proper trade size, okay? So we need a positive expectation strategy, which we have. You need to follow the proper trade size or position sizing. And the last thing is the hardest. In order to be a winner in this environment, you have to check your ego at the door. And that's why what I'm trying to do and what I'm trying to show you is be as mechanical as you can with trading. And I've heard it said many times, when your trading becomes boring, you've made it. You've made it. What we're doing here is we're investing our hard-earned money, okay? And we're not in this for excitement. You want excitement, you go to the local casino, or you go to a horse race, or you go to a football game, or you go to a, you know, one of those things. Go to a movie, although you can't go to movies nowadays. Okay? We're here to make money, and we're here to do that by investing in a non-emotional process. And that means that we want to be as mechanical as possible. And when we have a loser, it's like, that is part of trading. That is part of trading, okay? I see a setup again. I'm not going to worry about that loser. I'm going to put the same amount on as I had before, and I'm going to execute the trade. That's when you will become a success. Okay? All right. I hope you all found that interesting. Like I said, when I took the seminar, that was on day one, and boy, oh boy, my eyes just bugged out of my head, because it's like, this guy really, really, really is going to be able to help me. And he surely did. Positive expectation strategy, proper position sizing, and individual psychology. Okie doke. Okay, let's see. Let me see if I can find something that I wanted to show you all. And that was a question that Percy had. Let me see if I can get the answer to that. Let me come over here and see if I can find this. Expectations, no. Percy, help me out here. Do you remember what your question was? I'm almost positive I had done a PowerPoint in response to that, but I can't seem to find it right now. Oh, yeah. Let me see. It was about, yeah, max profit. You got it. You got it. Let me see if I can find, let's see if I can find anything on max profit. Max profit, max profit. Let's see if I can find anything over here. Max profit, max profit. Nope. Nope. Yeah, I can't. I had put together a little PowerPoint on that, Percy, and basically what let me kind of wing it, I guess. if we go through the latest RUT trade, we go through the latest RUT trade. Let me see if I didn't write it down over here. But on RUT, okay, we got in right here on the measured move to the downside, and the credit was $1.50. Okay, and I always talk about the max profit or the max loss, and on $1.50, I'm looking at about 10% of the margin requirement, or $1 for a max profit, and I'm looking at about 6% or 60 cents for the max loss. Now, those are just the average. Those are just the average, basing the exit on measured moves going against this or the Fibonacci's. Okay. So the max profit and max loss are just really the average, Percy. That I don't use those as indicators, if you will, to get out. Okay. I'll look at it and I'll say, oh, okay, this is about, this is about, 90% of what I really want to get, or I'm losing about 50%. I better be careful here. But it's really the measured move, or the 5 dropping below the 8 for the loss, or the Fibonacci's for the profit. Okay. So the max loss and max profit are basically averages based on those rules. Okay, Joseph has a question. How do you, I hope that, okay, that's good, Percy. That's good. Okay. Joseph says, how do you determine the starting point of a measured move? Okay. The starting point of a measured move is if you have a trend going up, okay, it's going to be in that trend until it has a correction, okay, and then makes a lower high. Okay, notice this one came up, had a correction, but made a higher high. This is a positive measure. This is a bullish measured move, if you will. This one, you don't know if it's a bullish measured move or not until this happens. And you had a lower high and then a lower low. This is a measured move. So the start point, Joseph, is always at the high or at the low, okay? So this would be the start point down here of the measured move going to the upside. This would be the start point down up here for a measured move going to the downside. And then you'll have them in between here that was a high, okay? And then it didn't make a higher high, which would have been a measured move to the upside. It made a lower high and then down it went. Does that answer your question, Joseph? Okay. All right, good deal. All right, another question here is, can you take a quick look at Amazon for a possible bull put? It was the -3, the 5 crossed over the 8. Looks like it made a major move yesterday. Okay, absolutely. That's exactly what happened. We did have the 5 did cross over the 8, which is a good sign. It was all the way down to the -2. It came up. It made a higher low and then made a higher high. This is a measured move to the upside. Okay. Here's where we start. This is the low. come up here, then we come down here, and that is when it made a higher high, that is a measured move. Okay, once it makes a measured move, we can put on a Fibonacci extension from that low to the high and then back down here and see that the 127 is up around here. So this would be a good trade to get into. Now, it's a little weak today. It's a little weak today, but everything is saying that an Amazon bull put would be a good trade. So let's go through. What would we do? Let's go through. This would be a monthly, so we want to go out about a month. Let's go out to the 30 October. See, right away I'm seeing not a lot of open interest here, so I don't like that. Let me see if I can go to. See, if I go all the way out to 20 November, that's too far out. And the 16 October doesn't give it enough time to work. See, I'm not getting a lot of open interest here, and I need about 100. So I'm having trouble putting in an Amazon trade at this point in time, unless I go all the way out here, which I don't really like to do. And even there, I'm not getting a lot of open interest. So I'm gonna at this point in time, I'm gonna skip Amazon. Okay, Joseph says, yes, the difficulty for me is determining a measured move while in a trend. It's much clearer looking back, but much harder when you're in a trade. Oh yeah, we always trade on the right-hand side of the chart, and we don't know what's going to be going on in the future. Okay, so it is easier to see measured moves back here versus an evolving measured move. Okay. But let's say you're in a trend. Let's Amazon's probably let me go back in time on Amazon. Maybe go back 6 months. Okay, so you can see that Amazon was trending up. All right. Okay, so it's trending up. So right here is a low. See a low? Okay, so that would be a start point for your measured move. Comes up to a high, all right, makes a higher high right here, pulls back, okay, but continues on up, all right. That's that. Okay, so that's a measured move within a trend. So let's keep going. Okay, so here's a low. So we can go from that low to this high to this higher low, and there's a measured move right there, okay? And there's the 161 right there. So if you got in here, you would be in for about 2 weeks. Okay, Joseph, so picking out measured moves within a trend, that's where your profits are going to be most of the time. Most of the time, that's where your profits are going to be. All right. What you want to key on is if you're in a positive trend to the upside and you have a pullback, then you want to be on the alert for a move to the upside that's going to make a higher high. Okay. If you have a pullback, that doesn't go below this point here, you have the makings of a measured move, okay? Because this is a higher low. So you can put this in it here right now, and as soon as it goes above there right here, you're in. Now, Joseph, this is going to take a lot of practice. So what I suggest is that you pull up any chart at random and just see if you can find measured moves within a trend. Now, remember, I'm here for you. So if you're practicing, and let's say you're doing a one on Lunar or Apple or one of those, and you think you see a measured move, email me. Take a screenshot and email me, and I would be glad to look at it and say, yes, indeed, that was a measured move. Or no, it wasn't because this, and this happened. Okay? So practice it. If you get stuck, remember I'm here to help you. Okay, so we decided not to get into an Amazon bull put. Let's just take a look at our two trades that we currently have. One is MDT, and MDT, you can see that, well, what we did is here was a high, okay? And actually, it came down, made what I would consider to be a double top. That was close enough to say a double top. And when it came down to below here, that made a measured move to the downside. And that's when we got in, okay? And down it went. The 5 is below the 8 and continues to be so. And we're making money on our MDT. Okay. The other bear call we have is Visa. Now, I want to ask you all your opinion on Visa. We've made a little bit of money on Visa, not a lot. We actually had the measured move occurred right there, and we got in, and then it kind of meandered around in the last couple of days. The 5 is almost above the 8. Okay. Hasn't made a major move to the upside, but the 5 is almost over the 8. I think we've made about 20 or 30% on Visa. And this is one of those that if the 5 crosses over the 8, I would want to exit. So my question is to you all, would you exit Visa today? 1, yes, 2, no. Go ahead and vote. 1, yes, 2, no. Let me blow this up for you. Would you exit Visa today? 1, yes, 2, no. Doesn't cost anything to vote. 1, yes, 2, no. Okay, so this is interesting. 50% of you say yes. 50% of you say no. Okay, so what are the rules? What are the rules? If I have a trade on and we have a measured move that goes against us, which we have not had, or the 5 crosses over the 8, I'm out. Has the 5 crossed over the 8 just yet? No. Therefore, I am in. Okay, it's just that easy. You know, the rules say if if you have a major move against, get out. If the 5 crosses over the 8 against you, get out. That has not happened, so I'm still in. Might it happen in the next day or two? Absolutely. Is it happening now? No. Okay. See, and what I find interesting is that 50% of you said, you know, let's get out. 50% said, let's not get out. You need to be 100% committed to the rules and follow them, just like with the ball example. Okay. All righty. So what can you say? Well, you know, I got a meeting at 2 o'clock, and I'm not going to have time to do this today. It's okay. That's okay. You're not going to, you know, lose a lot of money that's the beauty of a leap. You know, this is not going to move that much. You've got a meeting coming up. Right now it says, you know, let her ride. Guess what? Let her ride and go to your meeting and check on it whenever you can. You don't need to be a chart hawker. Follow this all day long, all day long, all day long. I don't. What I do try to do is put in some alerts, and let me show you how to do that. Let's say it comes up to around here. Well, probably it's gonna be crossing. So I'm gonna put in an alert there by right-clicking. See where it says create an alert? And if it goes at or above there, I want to be alerted. And what's going to happen is my computer's going to go ding, 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 ding. And I'm going to get a text on my email. And I'm going to come in here and take a look at this and say, oh, guess what? The 5 just crossed over the 8. I'm out. Okay. All righty. So we have some time to look at any stocks you would like to, or ask any questions you would like to. So I'm going to turn the webinar over to you. I did want to just say that October 14th is earnings for Alcoa. I was kind of caught by the earnings in Costco because it was kind of in the middle of nothing. But earnings season really starts, in my mind, October 14th with the earnings of Alcoa coming out. So that's when my earnings season really starts. So sorry I got caught on Costco, and you'll notice we got out of that really quick. Any questions? Any questions? Anybody want me to look at anything? Now is your time. There's a major move to the downside on the SPX, but just a tiny one. Just a tiny one. Is Costco setting itself up for a bull put? Let's take a peek. Let me go back here to this guy. And is it setting itself up for a bull put? Well, there was a low, and it came up here, and it made a higher low, and it just made a measured move. Yes, it is. Yes, it is. It's getting pretty dicey up here, but it does have some room to run there. Let's just take a look, Tricia, and see if we can get some good open interest on Costco. Let's see. We want to go out about 100 days. Let's go out. Let's go out to 15 January. Looks like we got plenty of open interest. 15 January. So let me write this down because this is going to be, I'm going to have to send out an alert on this. This is a good trade. Right now, you'll see it's at 351. 351. And I want to put a bull put on. So I want to subtract 49. Okay, here's three. Currently, it's at 351. I want to subtract 49. And just to make it easy, I'm going to say that's around 300. Okay, so that's my target for where I want to sell. So I want to sell this at 300, and I got plenty of open interest. And then I want a 10-point spread, so I want to buy then a 290, and it's got plenty of open interest. So let's go ahead and put that guy in there. We want to sell a vertical bull put 300 and 290 for about $1.27. So we're going to 15 January, and we are selling the 300, and we're buying the 290 put at, let's just call it $1.30. Let's go ahead and confirm. Sell 10, $1.30, blah, blah, blah. Max profit, okay. Yeah, that's good. Okay. So you can either put that in now, or yes, Joseph, we do have a positive measure move on Amazon, but there's very little open interest. You can either put that in now or wait till you get the alert, which I'm going to be sending out momentarily. So that was a good one, Tricia. Good call. Anything else? Thanks, Tricia. That's very nice. Okay, let's call it a webinar. Remember, this will be recorded. It has been recorded. I'll compress it and put it on the website within about an hour or two. And then we'll have one next Tuesday. Between now and then, any questions? And Joseph, as you're practicing your measured moves, remember to email me. Any questions you have between now and then, just send me an email, dbrethauer@comcast.net, and we will talk to you next Tuesday. Good trading, everybody. Bye-bye now.